Good evening. This is Doc Severson for the TheoTrade report for Thursday, February 22nd. I'm going to start out here with about a 50-year chart of the 10-year note, and you can see how the 10-year note in the 60s and 70s into the early 80s was actually rising to a level of about 16%. And since that point, we've been in this massive downtrend with lower highs, lower lows, and right now we're starting to see a potential breakout above that level, at least this short-term bottoming level, as we got down below 1.5% on the 10-year note. Right, so we can see the reasons for all of this. This was all the quantitative easing where you print money, print money, print money, you debase the currency, and then since that point, since we've started to tighten things up, and since a little over a year ago, where the economy started to recover with gusto, we've started to see the yield starting to rise again. And we're threatening to go up above 3% now, and it's spooking the markets. Now, the fact that we're in a rising rate environment right now, at least that's what we're perceived to be in, the last few decisions have been to hike rates. I mean, sporadically, but still we're hiking rates about 0.25% per meeting now. And this is not new. This is what happened back in 2004 all the way through 2007 to the very end of 2007 when things got to be very unstable, is that every Fed meeting was another quarter point, another quarter point, another quarter point. Well, what's different between what happened there, and this was all during a rising stock market, right? From 2003 to 2007, we had a rising rate environment. So here we go again. So linear logic dictates, well, in a rising rate environment, that's not going to hurt the market all that much. We've been through that before. Well, that's true, but here's what's different. What is different is that we've picked up a tremendous amount of debt since that point between various escapades overseas as well as recovery efforts and quantitative easing, everything like that, that we've more than doubled the debt load since that point. So for us to go above 3% means a huge, huge difference in the debt payments that we have to afford. And this is why it's potentially different this time. So if we look out at the CME group, we can start to get probabilities for where our rates are going to be. At least the discount rate that we have here, which is an 83% chance of a rise in the rates here on, I believe that's 21st of March next month, about a month from now. So there's a pretty strong possibility that we're going to be raising that rate at that point. So some of the other big ones, let's just look at the big ones, because some of these ones in between, usually you don't see much of a chance of. So right now, 76% chance of no change in the May. But when we get to June, this is where we start to see a better than even chance of a rate hike again. And if we go out to September, we see kind of even odds of another rate hike. So right now what the market's pricing in is that every subsequent quarter we're going to be hiking rates, although it starts to slow down by the end of the year. So the problem is this big free money party that we've had, where basically 0% interest rates until recently have led to, there's no yield anywhere. There's no yield at all anywhere else. So there's only one place to put your money, which was into equities. Well, that is going to flip at some point here fairly soon. Now, I am still anticipating, based on what the price is showing, still anticipating that we're going to be in this fairly large range here for at least the next 3 to 4 months. Now, what happens after that is, of course, very interesting, because normally we see a lot of volatility within this range, and then either we recover back to quiet and trending again, and by that time, by the way, we're going to be fully charged up again. This is exactly what the market needed to do after this enormous move after the 2016 election. So one of two things will happen from this. Either we're going to bust out of there, and I think this would surprise a lot of people if we actually went to the upside, but it can do whatever it wants to do. Or perhaps we're going to have a replay of the spring of 2008 where we start to trend to the downside here and put in a significant lower high on the larger time frame charts. Now, for right now, I don't believe there's anything to do for this. There's nothing to do for this right now. Tops are a process. So even through the worst of times, tops are still a process. So it took months before the 2007 market went into one of the worst recessions that we've ever seen. It took months before that released to the downside. We'll probably see the same thing happen here. Months of volatility before we're going to see release in one way or the other. So in the meantime, what we have to do, our job right now, is going to be to determine whether or not the price is, I don't think it's going to be doing the V-bottom thing at this point. I don't think we're going to be V-bottoming. I think we're going to be going into small consolidation. That's exactly what it's showing. Now, the shorter that this consolidation is, the more likely that we see a breakout to the upside and perhaps a retest of the former highs before rolling down again and playing the big range game here. So that's one potential. The other potential is that we see this consolidation go on for a little while, and the longer that it goes on, the more likely that we're going to pull down again and start this pattern by retesting the lows again. So we're going to play this one thing at a time. We're not going to look too far out. If we try to play too far out, we'll catch ourselves being on the wrong side of the bias for this. Let's keep it short-term focused on determining what this range is going to do, whether or not it's going to break out to the upside or to the downside. But never a bad idea at this point, especially as volatility starts to come in just a little bit, to make sure that you're hedged appropriately to the downside, especially if you have an exceedingly long portfolio. That's it for today's report. Thanks for listening. We'll see you tomorrow.